Good morning, welcome to CATEX TV. My name is Frank Fortunato. Today is Thursday, June 13th, 2013. The big story continues to be weather in the United States. A massive storm system is moving across the Midwest, now heading to the east coast of the U.S. It's expected to arrive in the New York metropolitan area sometime earlier in the mid-morning, approximately 10 a.m. Flood warnings and tornado alerts, incredibly, are up here in New Jersey and in western New York State. And Washington, D.C., Baltimore, and Philadelphia, and Boston are also expected to be affected during the day as well. The storm system had been predicted to be particularly dangerous for the Midwest. Fortunately, it did not quite live up to the billing of its ferocity in advance. Meteorologists had been concerned about a weather trend called a derecho, which is a storm of strong straight-line winds spanning at least 240 miles. That did not occur, and meteorologists say that with each passing hour, without one having occurred, it's less and less likely that that will happen. The storm did severely affect rush hour traffic last evening in Chicago and seriously slowed flights down at the two major airports there. And it, as we speak, is somewhere over eastern Pennsylvania, heading in our direction. Interesting news coming out of New York State. The New York Times is reporting that the Financial Services Superintendent, Benjamin Lawsky, is beginning an investigation of the life insurance industry's use of captives. Lawsky claims that life insurance carriers in New York State have $48 billion in shadow insurance. He says that insurers use these captives to decrease the amount of capital that they're required to hold. The department said that 17 New York-based firms use such transactions. They were not identified. The captives are typically based in other jurisdictions, and they are sometimes capitalized simply with letters of credit, or worse yet, intra-company guarantees that can leave the parent responsible for claims if losses mount. Of course, the whole idea behind this is that insurance companies are supposed to maintain a level of reserves that needs to be there, rock solid, tangible in the event of claims. If the insurance company can transfer responsibility for payment of claims to a captive company where the security is only a letter of credit or an intra-company guarantee, that then frees the insurance company up to use the reserves that would have been held for other purposes. Lawsky said the fact that certain insurers are inappropriately using shell games to hide risk and loosen reserve requirements is greatly troubling. Shadow insurance, he says, allows companies to divert reserves for other purposes besides paying policyholder claims. Only one company actually commented, that was Metropolitan Life, which said that these contracts are a cost-effective way of addressing overly conservative reserving requirements. There'll be a lot more on this, you can be sure. Meanwhile, some news is beginning to come out of the July 1 renewals down in Florida, especially regarding the massive reinsurance program for Citizens, the Florida Joint Underwriting Association type vehicle. Apparently, new ILS companies are really beginning to make some serious inroads here. The new startup called Q-Re, which is based in Qatar, provided almost $28 million of new capacity this year as collateralized reinsurers lifted their share of the market placement. Some of the old liners continue to do well. Validus lifted its line by almost $63 million, and Munich Re also doubled its line. Some of the Lloyd's syndicates that jumped in for the first time or increased their amounts were Ark, Barbican, Chaucer, Canopius, Nove, and Talbot. Now, insofar as collateralized reinsurance, D.E. Shaw was the biggest jumper. They wrote just under $100 million of limit for this year's contract compared to about $35 million last year. Nephila Capital also jumped. They went from about $42 million to about $90 million. Also jumping in for the first time were Aeolus Re and AlphaCat, which is a subsidiary for Validus. So this once again goes to show that the insurance-linked security underwriters are beginning to get into the mainstream. You can't get any more mainstream than Florida wind. John Charman, as everybody knows, has joined Endurance and is making a lot of noise in that long interview in the Insurance Insider. The man he replaced, Dave Cash, yesterday sold about $10 million of his shares in Endurance, according to the Securities and Exchange Commission. Cash had worked at Endurance since its beginning in 2001. He stepped down from the post in order to make way for the arrival of Charman. According to the SEC, Cash sold 100,000 shares on Monday and another 94,000 on Tuesday for an average of about $50.50 each, for a total net of about $9.8 million. He still has about 124,000 shares of Endurance, worth about $6.25 million right now. Again, Dave Cash is a good guy, but Charman is a bit of a force of nature, and also between his family's accounts and his own accounts, he owns a significant amount of Endurance stock. So you do the math. That's the news for today. We're here waiting for the tornadoes. Hopefully none will come. If we have any breaking news, we'll come back and tell you. Thank you for watching, and we'll see you tomorrow.